Hello, everybody. This is Brian Lysing with Financial Brokerage, and you have just joined the Sequence of Returns webinar. Do the sequence of returns really matter during a client's retirement years? Well, that's what we're going to discuss and try to find out in today's webinar. I would like to thank all of you for joining us here today and taking time out of your business practice to learn what I think is a very valuable sales idea. A little housekeeping note, all of your lines are muted. We do that to cut down on the background noise so that everybody can hear the sales ideas. You do still have the ability to ask questions. You can do that by typing in the control panel that you see on your screen, and I will get to as many of those as time allows at the conclusion of today's webinar. So for those of you that may be new to financial brokerage, we are a national marketing organization working with advisors and agents all across the country in the areas of life insurance, annuities, long-term care, Medicare supplements, disability insurance, and critical illness insurance. As I mentioned earlier, my name is Brian Lysing. I am one of our life insurance marketers, and that's been my area of specialty here for nearly 20 years now. And really my favorite part of the business when I was out very actively selling prior to coming here. So we'll get right into this. The end game here that we're getting at is to help you find a way to sell more index universal life insurance. I'm going to get that out there from the very start. But we're going to get there by discussing what's called the sequence of returns. Now, this is something that people don't usually talk about when discussing retirement planning, but it does give you a way to set yourself apart from all the other advisors out there who might only focus on accumulating assets for clients, but are lacking a bit when it comes to distributing those funds in an optimal manner. Now, we do have a special thank you this morning for some of our partner companies. At Financial Brokerage, we work with about 25 different life insurance companies, and the material that you'll see in today's webinar comes to us from three of them, Equitable, Mutual of Omaha, and North American. And I do actually have the PDFs with all of these ideas available to everybody who attends today. So we'll have your email addresses, and we'll be able to get those to you afterwards. Now, what are we going to cover today? Well, really just three items. What is the sequence of returns? Does it really matter? And how IUL can help your clients with this. In fact, we've got three different examples that illustrate the scenario in action that really help tell the story and show how big a deal that this really is for your clients in their retirement years. So if you're not familiar with this concept already, the sequence of returns is just the order of positive and negative annual returns in a client's portfolio. Now, why is this a big deal? Well, it can really impact your client's portfolio. Retirees have to expect market downturns from time to time, but when they have to sell into these market losses, it can really be detrimental to their retirement portfolio, especially in the early years. It certainly changes how long their money lasts. But the hardest part is explaining this concept to your client. Now, before we get to that, though, I want to pause briefly and share a scenario where the sequence of returns doesn't matter. And it doesn't matter during the accumulation phase. And we've got some numbers here that will prove it. In fact, we're going to take a look at three different retirement accounts accumulating over 25 years, but with different sequences. Each one you're going to see is going to end up in exactly the same place. So here are those three sequences. Now, in column A, we have a set of returns, and these are all hypothetical, but we have a set of returns in column A. In column B, we have exactly the reverse set of returns and losses. But in this case, the losses, since it's reversed, are all congregated near the beginning rather than at the end. And column C shows an average. It's the same returns every year, but the average that you would have seen in column A or B. Now, in the accumulation phase, the order that you get to the end really doesn't matter. You end up in the same place. And if you look at the very bottom line there, you're going to see, even with these different orders of returns, the client ends up with the same amount of money. Again, we took A, column A, hypothetical, B, we just flipped it around exactly the opposite, and C, we have the average. We get to the same place. Doesn't really matter, right? Well, everything changes in the distribution phase of retirement. And we're going to see what happens with different returns when we start pulling money out for income, because that really is what makes the difference here. So now we're going to look at the exact same sequence of returns we saw earlier. But in this case, our client is taking $85,000 a year to live on. Now, they're okay if we have the returns that you see in column A, where we have more of the negatives clustered near the end. But look what happens in column B when they begin retirement with a few negative years. In fact, column B, you might think about people who retired around 2001 or especially 2008, where they saw a lot of negative returns early on. Now, in this scenario, our client's money is gone before the 10th year. And again, if you look at column C, where the average returns are exactly the same, but not the sequence, their money doesn't last for the whole 25-year time period. In fact, our clients don't even make it to year 20 with the same average return. So the sequence of returns really does make a big, big difference on the distribution end of things in a client's retirement years. Well, we've got another example. I mentioned we were going to have several that tell the story. So here's one that comes from Mutual of Omaha. The last one we looked at, by the way, was from a piece put together by Equitable. But in this one from Mutual of Omaha, we're going to see two retirement accounts. Both of them started $1 million at age 65 and show our retiree taking just over $68,000 a year, and in this case, increasing at a 2% annual rate to help offset inflation. So here's what that example is going to look like. Scenario one on the left assumes our client retired in 1973. And if our client did that, they would run out of money at age 86 if they lived that long. Now, if our client instead would have retired in 1982 and was 65 in 1982, they would still have $6 million left at age 86. Now, both of our clients started with the same $1 million and took the same amount of income each year. But because the sequence of returns was different, one client had a lot more money left over than the other one. And in fact, here's another way you can envision that difference. We've taken the same data and just brought it into a more visual format. And here it's real easy to see the market performance was very, very different in those time frames. But also, if you take a look at that there, the clients actually averaged the same returns in both time frames, but yet they ended up with very, very different results. In fact, over those two 25-year time periods, both clients averaged about 14%. So why did one run out of money while the other one still had plenty? Well, it all has to do with when the losses occurred. Our first client didn't have time to recover his losses while the second one did. So it really matters when you retire. And unfortunately, you don't have any way to predict the future and know what those returns are going to be and what order they're going to come in. So how do you plan for something like this? When the markets are down, people still have to pay their bills. Now, going conservative and putting all your money into safe, low-risk investments, it really doesn't completely solve the problem either, because clients are still counting on their money to grow. Low-risk savings like CDs and bonds, they're just not going to get the job done. Luckily, though, your client does have another option, and that's a properly funded index universal life insurance policy. Now, why are we looking at IUL? Well, IUL can provide a tax-free death benefit to the client's heirs. Most importantly, though, in our case here, it builds cash value that can be accessed via loans and or withdrawals and has absolutely no stock market risk of loss. And I forgot to put one more bullet point on this one, too. There is no taxation on these funds when your client pulls them out. So several reasons why we're going to take a look at an IUL as an addition to our client's traditional retirement portfolio. So let's take a look at what our client could have had in that 1973 to 1998 scenario if they had an IUL in place. Now, this example still comes from Mutual of Omaha, and in this case, we're assuming they purchased a $500,000 income advantage IUL policy. They still have this product available for sale currently, and client purchased it at age 40, paid $500 a month through age 65. Now, off of that, we're projecting over $260,000 of cash value at that retirement age. So now our client has another source of income. They don't have to sell at a loss after a market downturn. And you're going to see that there are several of those downturns happening in this scenario here on the chart that you see on the screen. All right, now we have yet another example. I mentioned we'd have 3 to help tell the story. This one comes from Equitable, and we're going to take a look at Tom. Tom starts with $1 million in retirement, and he needs $70,000 a year, indexed for inflation, from his accumulated retirement funds. Well, here's what Tom's account looks like after 20 years of market ups and downs, including selling at a loss in a few of those years. You'll see at the top, he started with $1 million and still has $446,000 left at the end of that time period. So, Tom's not doing too terribly bad. He hasn't completely exhausted his account by age 85, and he's taken what he needed to live on. But what if Tom could do a little bit better? Well, if Tom could avoid selling at a loss in those 5 down market years along the way, out of those 20, just by pulling money from his IUL, look at what he would have. If we see down there at the bottom with the light blue highlight around it, Tom would have about $3.5 million in his retirement account at year 20. Now, that $446,000 we saw on the last slide doesn't look quite so good anymore. It was looking good then, but $446,000 is not $3.5 million. That's a difference of about $3 million, all just because of the sequence of returns. Now, if you could show a client how they could potentially increase their assets by $3 million given the same market returns, wouldn't they choose you over another advisor who was doing the opposite? All right, now this difference, once again, looks even greater when we place it all into a graphic format, and it's pretty easy to figure out which scenario you would choose if you were a client looking at this. All right, moving on to our third and final example. This one comes to us from North American, and this client has a similar story to tell, as you might expect. But in this case, our client's going to start out with $1.5 million and withdraws $50,000 a year, indexed up for inflation. Now, you would think that our client's going to have a lot more money because we're starting with a higher amount than we have in any of these other examples, and we're also withdrawing a little bit less. So that's a difference. But another difference, I think, here is the time frame that we used. North American shows the most recent 20 years of returns. I would assume most people you're working with would be able to relate to these years much, much easier because they're so recent. They can probably remember what they were doing in those years, where they were working, where they lived, who won the Super Bowl, et cetera. It's not quite so far in the past as 1973 or 1982 was. But in this case, our client's $1.5 million is nearly gone by year 20. The last guy we looked at, Tom, he still had plenty of money after 20 or 25 years. But in this case, it's almost gone by year 20. And there's some reasons for that. There were some pretty drastic declines along the way, and particularly in the first 10 years. We have a negative 13% in our first year of retirement, followed by a negative 23%. I mean, that's just awful. We're starting things off on the wrong foot. And then we do okay for a few years, but then we get hit with this negative 38% in 2008. So just to kick our client while they're down, right? So what a terrible time to retire, the way most people usually do with a traditional retirement account. Now, this person, based on this history, is probably a greeter at your local Walmart right now, I would imagine. Um, but there is good news here. Here's what happens or would have happened if our client had an IUL to pull money from in those down market years. Now, instead of having to pull from that market-based account and sell at a loss, they can pull money from their life insurance policy through a loan, and they're going to end up with about $500,000 more in their retirement account at the end, just because they planned for the sequence of returns. So it makes a really, really big difference for our clients. And as I mentioned earlier, to recap, sequence of returns, it doesn't matter so much in the accumulation phase of retirement planning, but it does make a big difference in the distribution phase. And having a non-correlated side account is going to make a huge difference when our clients aren't forced to sell at a loss. We're looking at index universal life for several reasons. IUL gives our clients upside potential, absolutely no downside risk. We don't have to worry about federal income taxes. Expenses are traditionally very, very low when compared to other investments our clients might use. We do have a tax-free residual death benefit to the client's heirs. And also, most of these IULs have some form of long-term care coverage, either built into the contract or as an additional rider that you can tack on, so our client has some additional protection that way. So that's the sequence of returns. And as I mentioned earlier, we do have these materials available in PDF format. And for all of you that are attending, I'll make sure that we email those over to you. And that way you can choose which one you want to use with each client. And depending on your client, you might want to use different ones as well. These are not the only companies offering IUL that we work with here at Financial Brokerage, but they are the only three that have pieces on this concept, the sequence of returns in particular. So I want to thank everybody for joining us this morning. Feel free to reach out to us if you have further questions on this topic or some clients where we can assist more specifically. Our number is 800-475-5555.